Very good morning, dear comrades. We are in the chapter Amalgamation. Let me discuss the entire concepts till now what we have discussed in this chapter through a small mind map. Then I'll continue my flow, the pending concepts. Then I'll take it into the consideration. So we started our journey with the concept of reconstruction. Reconstruction is nothing but a restructuring of existing financial statements. The main reason for going to reconstruction is the existing financial statements may not depicting the true picture. Then we have two options. Either we can go for internal reconstruction or either we can go for external reconstruction. The main difference between internal reconstruction and external reconstruction is, in case of internal reconstruction, no liquidation coming to takes place. But in case of external reconstruction, the existing company going to liquidated and a new company is incorporated to take over the existing company. So amalgamation in the nature of merger is a classic example for external reconstruction. That point also I clearly established at that point of time. Then totally we discussed three concepts. There is amalgamation, absorption and external reconstruction. In case of amalgamation, a new company is incorporated to take over two or more companies. For example, A Limited is an existing company, B Limited is another existing company. A new company so-called as AB Limited is incorporated to take over both A Limited as well as B Limited. Then such type of process is known as amalgamation. In case of absorption, an existing company is ready to take over another existing company. There are two companies, one is A Limited and B Limited. Both are existing company. Now B Limited decided to take over A Limited. Then such process is known as absorption. Coming to external reconstruction, a new company is incorporated to take over one existing company. For example, two companies are there. Only one company is there, which is A Limited. Now B Limited is incorporated to take over the A Limited. Then such process is known as external reconstruction. So basically, or conceptually, there is a difference between amalgamation, absorption, and external reconstruction. But coming to accounting perspective, there is no difference, because whether it is amalgamation or absorption or external reconstruction, there are only two different types of companies exist. One is purchasing company, another one is selling company, or you can call it as transferee company or transferor company, or you can also call it as vendee company or vendor company, or amalgamated company or amalgamating company, whatever the case may be. Then coming to the main chapter, amalgamation, there are two different types of amalgamations are possible. One is amalgamation in the nature of merger, another one is amalgamation in the nature of purchase. When an amalgamation is said to be amalgamation in the nature of merger, if 5 conditions simultaneously satisfied, then such amalgamation is said to be amalgamation in the nature of merger. The first and foremost condition is all the assets and liabilities should be taken over by purchasing company. All the assets and liabilities should be taken over at book values only. The PC should be disbursed only in the form of fully paid up equity shares only. That means there is no other form is possible in the form of cash, in the form of debentures, in the form of preference shares is not possible. To set such amalgamation is amalgamation in the nature of merger. And one more important condition is shareholders holding at least 90% of the share capital of the selling company would become the shareholders of the purchasing company after amalgamation, and the same business or the same line of business should be continued by the purchasing company after takeover of the business. If any one of the condition is deviated, then amalgamation is known as amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, then the method of accounting followed is pooling of interest method. If the amalgamation is in the nature of purchase, method of accounting followed is purchase method. And one more important thing you need to remember here, sir, the method of amalgamation or the type of amalgamation is relevant only in the books of purchasing company. In the books of selling company, method of amalgamation is irrelevant. Simply we are following the generally accepted accounting principles. So before going to discuss the accounting treatment in the books of selling company as well as purchasing company, first let us check one more important concept, which is PC calculation. For PC calculation, AS 14 is applicable. As per accounting standard 14, amount payable by purchasing company to the shareholders of the selling company alone considered as PC. So coming to CA inter level, there are 4 different types of PCs are given in the text. That is, one is lump sum method, another one is net payments method, another one is net asset value method, and the last method is intrinsic value method. In case of lump sum method, the PC directly fixed or ad hoc consideration decided by the purchasing company. The same figures are given in the problem itself. There is no hesitation in calculation of PC. But coming to net payments method, amount payable to equity shareholders and amount payable to preference shareholders, we should need to sum up. Then we will get PC under net payments method. Then coming to net asset value method, you should need to calculate what are all the different assets taken over by the purchasing company. That too, we should need to consider such assets at agreed value. We need to reduce the liabilities taken over at the rate of agreed value. Then you will get net asset value of the business, which is equal to the PC in case of NAV method. Coming to the intrinsic value method, PC is nothing but intrinsic value per share in the selling company multiplied with the number of equity shares in the selling company. One more important issue actually I discussed in case of PC. Sir, PC can be recorded at issue price or PC can be recorded at par value. Sir, if PC can be recorded at issue price means the formula is number of shares issued as PC into issue price. If the PC is going to record it at par value is nothing but number of shares issued as PC, you should multiply it with a face value or par value. That point also you should need to remember. And I clearly established a fact that whether you are going to record the PC at issue price or you are going to record PC at purchase, that is par value, there is no difference. The impact is same. Still, that thing had to be proved for you. But I made a conclusion that there is no difference in the accounting treatment, whether you record it in issue price or par value. Next, coming to the accounting treatment in the books of selling company, AS 14 doesn't applicable. Generally accepted accounting principles are applicable. We've seen through 5-step approach. Step number 1, dismantling of balance sheet. What are all the different assets and liabilities taken over by the purchasing company should be closed and transferred to realization account. At which values? Book values. If any of the particular asset or liability which is not taken over by the purchasing company, like a cash or any other liability or any other asset, we should need to open a separate ledger. Then reserves and surplus, equity share capital, any miscellaneous expenditure not written off or preliminary expenses not written off, those are fictitious assets, you should need to transfer to equity shareholders account. If any preference share capital is there, you should need to transfer to preference shareholders account. That is nothing but dismantling of balance sheet. Then coming to step number 2, PC due. Before proceeding with step number 2, PC due, in working note, you should need to calculate PC. Just now we discussed how to calculate PC, what are the different methods of PC exist. Once the PC computation over under the working note, then you can continue with your accounting treatment. What is the journal entry for PC due? Purchasing company account data to realization account. The background story also I told at that point of time. We are simply selling our business to the purchasing company. That's why purchasing company is a debtor. That's why we should need to make debit the purchasing company account debtor to all the assets and liabilities. We already closed and transferred to realization. That's why rather than crediting the assets and liabilities, you can directly credit realization account. That is the concept behind the PC due entry. Next, step number 3, PC receipt. In the form of PC, you may receive cash, you may receive debentures of the purchasing company, or you may receive preference shares of the purchasing company, or you may receive equity shares of the purchasing company. That's why the entry is as follows: cash account debtor, debentures of purchasing company account debtor, preference shares of purchasing company account debtor, equity shares of purchasing company account debtor to debtor. Who is such debtor? Purchasing company. Next, once the PC received, and if any of the particular assets which is not taken over by the purchasing company, you are having all such resources. Such resources you should need to distribute in a particular order as per the liquidation provisions. The order is: first you need to incur liquidation expenses, then secured creditors, then unsecured creditors, then preference shareholders, then finally you can make settle to the equity shareholders. Now, during the process of settlement, if any profit or loss you are realized, such profit or loss you should need to transfer to realization account. That is nothing but distribution of PC among the various stakeholders. But before distributing among the equity shareholders, first you should need to close the realization account. If you are getting the profit under realization account, the entry is realization to equity shareholders. If you are end up with loss, the entry is equity shareholders account to realization account. Then after transferring realization profit or loss to the equity shareholders account, then you need to check what are all the remaining resources available with the liquidator. Such remaining resources simply you can distribute among the equity shareholders. Then automatically such resources account got closed, as well as equity shareholders account also got closed, which is known as step number 5, which is final settlement to the equity shareholders. These are the 5 steps you need to remember while providing accounting treatment in the books of selling company. Now coming to accounting treatment in the books of purchasing company, if the amalgamation is in the nature of purchase, we need to adopt the purchase method. The first and foremost entry is business purchase entry, that is business purchase account to liquidator of selling company at the rate of PC. The crucial accounting treatment in case of purchase method is at the time of incorporation of assets and liabilities under second entry, you should need to compare the business purchase with the NAV value, because the assets and liabilities you are going to incorporate at agreed value. Assets minus liabilities means which is nothing but NAV. You should need to cancel the business purchase means which is nothing but PC. If the PC is under NAV method, there may be no difference between PC and NAV. There may be no chance of occurring goodwill or capital reserve. But if the PC calculation is other than under NAV method, it may be under lump sum method, or it may be under intrinsic value method, or it may be under net payments method. At that point of time, there may be a chance of PC greater than NAV or PC less than NAV. If it is the case, which is PC greater than NAV, then you can treat it as a goodwill. If it is the case, PC less than NAV, you can treat it as a capital reserve. Am I right? And one more important thing you need to remember here, after incorporation of assets and liabilities, you should need to make final settlement to the liquidator of selling company by passing the entry liquidator of selling company account to equity share capital, to preference share capital, to debentures. If such shares or debentures are issued at more than face value, you should also provide the excess of amount over face value to securities premium account. Am I right, guys? Then one important thing I also explained, I think so. Sir, in case of amalgamation in the nature of purchase, the reserves and surplus of the selling company is not taken over by the purchasing company due to any specific statute. If the purchasing company should need to maintain the statutory reserves of the selling company, then we need to pass one adjustment entry, which is amalgamation adjustment account to statutory reserve account. Amalgamation adjustment account is shown as a negative figure under reserves and surplus. Statutory reserve. Statutory reserve is shown under positive balance under reserves and surplus. That point also I clearly mentioned. Next, coming to the amalgamation in the nature of merger, the method of accounting treatment we need to adopt is pooling of interest method. So there is no difference in between purchase method and pooling of interest method, except one important point. What is such difference, guys? The reserves and surplus of the selling company is ultimately taken over by the purchasing company in case of pooling of interest method. That's why at the time of comparing PC with NAV, we need to compare PC with the share capital of the selling company, because here NAV is nothing but share capital of the selling company. I also clearly intimated that fact in the last class itself. Then if the PC is greater than the share capital of the selling company, which is loss, such loss we need to treat it as a revenue loss, and that loss should be set off with reserves and surplus of the transferee company. That is, such reserves also free reserves of the transferee company after takeover of reserves and surplus of transferor company. Free reserves means either P&L account or general reserve. No, sir, if the other is applicable, that is PC is less than share capital of the selling company, still we need to treat it as capital reserve. Now, I discussed certain special adjustments. Under such special adjustment, the first and foremost thing is intercompany owings. I think so, which was also discussed in the last class. If before amalgamation, there are certain transactions in between the selling company and purchasing company, due to which either selling company should need to pay certain amount to the purchasing company, or purchasing company should need to pay certain amount to the selling company. At that point of time, we should need to cancel with each other by passing the entry trade payable account at R to trade receivable account, or bills payable account at R to bills receivable account, or loan payable account at R to loan receivable account, according to the transaction entered in between both the parties. Am I right, guys? I think so. These are the issues I discussed in the last couple of lectures. The only two important things are pending conceptually from my side are stock reserve concept and a liquidation expenses concept. Now, in today's class, we are going to discuss such concepts along with problems. May I know, guys, all of you, is it right? Can I proceed? Please, all of you put thumb mark. Some of our student is asked that, sir, these notes are not available in the app, sir. I communicated with tech team also. It is not yet uploaded. No, ma, it was uploaded as on the date in which I taken lecture 1, actually. As on the same date, actually, I uploaded. Okay. Please check it, all of you. The date as on which I took actually, I taken the lecture number 1 as on the same date I actually uploaded. Anyway, today also once again I will upload once the class was over. Okay, fine. Please explain amalgamation adjustment reserve point again. Hiral, no worries. Anyway, in today's class we are going to deal problems. In such problems, again we are taking such points. Such adjustment again will come at that point of time. I will explain. Okay, fine. Now, please consider it, guys. Now the two pending concepts are, one is stock reserve, another one is liquidation expenses. First, coming to the stock reserve concept. Let us take two companies. One is Razu Limited, another one is Rani Limited. So this is Rani Limited, this is Razu Limited. Sir, before occurring amalgamation in between Rani Limited and Razu Limited sold goods to Rani Limited. Always Razu Limited sold goods to Rani Limited by adding 10% profit on cost price. By adding 10% profit on cost price. Sir, how much worth of goods sold by Razu Limited to the Rani Limited in this particular period, sir? 1 lakh. Let us assume 1 lakh. Now, out of such 1 lakh worth of goods, Rani Limited sold to outside customers. Rani Limited already sold to outside customers to the extent of 75,000 worth of goods. Maybe it sold by adding their own profit. That is different story. Now, my point here is, after selling 75,000 worth of goods, still Rani Limited had stock. Rani Limited held as closing stock for the worth of 25,000. Now, Razu Limited and Rani Limited are amalgamated. They are in the process of amalgamation. Razu Limited is ready to take over Rani Limited. Now, the stock of Rani Limited is ultimately taken over by whom? Razu Limited. Now here, the closing stock, Razu Limited is having their own closing stock. Let us assume for 2 lakhs. Now, after adding the Rani Limited closing stock, it will become 2,25,000. But my question is here, sir, the original stock of Razu Limited is at the rate of 100 rupees, which is at cost. Do you agree? Now this 25,000 worth of goods not at cost, because they are adding 10% profit on the cost price. They are adding 10% profit means this is at the rate of 110 rupees. This is at, you can tell it as NRV or the market price. You know the accounting principle for inventory as per AS2, always inventory is valued at cost or NRV, whichever is lower. I know if it is the material valuation, which is quite different, that is depending upon the finished good in which the raw material is used, decides the valuation principle. I know, but basically we can call it as the basic accounting principle, which is cost or NRV, whichever is lower. Now you can tell me, as per the applicable provisions of AS2, the cost is 100 and the NRV is 110 means cost or NRV, whichever is lower means at the rate of 100 rupees only we need to value the stock. But the original stock of Razu Limited is valued at cost only. But the stock which is acquiring from the Rani Limited is we are recording at NRV. That is against the provisions of AS2. That's why we need to reduce the stock. We should need to reduce the stock by applying the concept of stock reserve. By applying the concept of stock reserve. Stock reserve means we need to reduce the existing value of the stock. Less stock reserve. Sir, how much we need to reduce, sir? 10 rupees or 10%. In the form of percentage, if I can tell, 10% I need to reduce. Now, please allow me concentrate here. This 10% on cost price I need to reduce. 10% on cost price I need to reduce. But I don't know the cost price, which is the market value. Tell me, guys, all of you. If 100 is the cost, 10% is the profit, market price is 110. Now this 25,000 is showing at 110. Now I need to reduce for 10 rupees. How much? Which is 10 multiplied with 25,000 divided by 110. May I know the value, guys, all of you quickly? How much? 25,000 multiplied with 10 divided by 110. 2273, right? Which is 72.7, 2273. Now, in preparation of balance sheet, after takeover of Razu Limited, after takeover of Razu Limited, as after takeover of Rani Limited by Razu Limited. Now, how the stock we should need to present, you know, stock of Razu Limited, 2 lakhs. Stock of Rani Limited, 25,000. Less stock reserve, which is 2,273. Now, the net closing stock to be shown in balance sheet. 2,25,000 minus 2273, which is 2,22,727. This is the presentation in balance sheet. That's okay, sir. We understand that one. Then what is the journal entry we need to pass at that particular scenario? Can you please explain, sir? All of you, please concentrate. This is crucial. What is the journal entry we need to pass here? One thing is sure, here we are reducing the stock, right? We are reducing the stock means in generally stock is nothing but asset. If there is a reduction in asset means we need to credit it. If there is increase in asset, we should need to debit. If there is a reduction in asset, we should need to credit. That is to stock account. On behalf of the stock account, just I am recording it as a to stock reserve account. Because we are reducing the stock, that's why I'm using the word to stock reserve account. And the next question coming into my mind is, what is the debit aspect here? What is the debit aspect here? Now, all of you, please tell me here, you know, the original valuation of the stock is not at 25,000. The original worth of the stock is not at 25,000. The original worth of the stock is less than 25,000. But still, Razu Limited is ready to take over the stock of Rani Limited at the rate of 25,000. You can consider it as NAV. You can consider it as, sorry, one second. The original worth is less than 25,000 means you can consider it as NAV, but you are ready to pay to the extent of 25,000, which is PC. Just I am telling you for understanding purpose. I mean, the worth is less than 25,000, but still you are ready to pay 25,000. Why you are ready to pay the excess? The excess worth, how much you are paying? 2273. 2273 excess, why you are paying? Because which is the goodwill situation. The excess you are paying because of goodwill situation. So the situation is look like this. PC is greater than NAV. If PC is greater than NAV, you are incorporated it as goodwill, right? So that's why the debit aspect, you should need to record it as goodwill. So the entry is goodwill account at R2 stock reserve account. Do you understand, guys? All of you. Guys, one thing, a small emergency for me. Can you please be all of you hold for 5 minutes? A small emergency. Again, I'll come back by 7:30. Please, all of you in login mode only. Exactly within 5 minutes, I'll come back and I'll continue the session. Sir, I'll come back within 5 minutes, sir. Yeah, yes, guys, let us continue. Are you with me? All of you? Can I continue, guys? So finally, the journal entry at the time of stock reserve is goodwill account at R2 stock reserve account. So hope I clearly explained the background story related to the stock reserve. And one more important fact, just here I want to tell you. For example, you are in the amalgamation in the nature of purchase. In the second entry, let us assume that is at the time of incorporation of assets and liabilities. If you are end up with capital reserve, when capital reserve will come, that is PC is less than NAV situation. If PC is less than NAV situation, you are ultimately end up with capital reserve, right? At the time of recording the stock reserve, you may end up with goodwill, right? Now, goodwill is a capital loss. Capital reserve is a capital profit. You can set off goodwill with capital reserve at that point of time. Then the final entry is capital reserve account data to goodwill account. Do you understand in which situation it is possible? At the time of incorporation of assets and liabilities under amalgamation in the nature of purchase, or sometimes amalgamation in the nature of merger as well. If it is profitable situation, then you may end up with capital reserve. Whatever the type of amalgamation, there may be a chance of getting capital reserve at the time of incorporation of assets and liabilities. Then the goodwill arised at the time of incorporation of stock reserve, you can set off with the capital reserve by passing the entry capital reserve account at R2 goodwill account. That's why what I am telling, under the second entry, if you already end up with capital reserve, on behalf of debiting the goodwill, you can directly debit the capital reserve here itself. Then don't incorporate the goodwill. You can directly knock off with the capital reserve itself. Because if you incorporate the goodwill, again, you should need to set off with the capital reserve. That's why on behalf of incorporating the goodwill and passing one more entry, you can directly debit the capital reserve on behalf of the goodwill. That point just I am telling you for your convenience. Is it okay, guys? All of you? Fine. So this is all about the concept of stock reserve. Still, if any points are there, I'll going to explain at the time of resolving the problems. Next, coming to the next important concept, which is liquidation expenses. Please, all of you pay attention here, guys. So many students confused always about the liquidation expenses, the accounting treatment about liquidation expenses, and regularly they are testing in the examinations as well. Sir, we already discussed liquidation expenses concept. Na? Why again you are considered here? We actually discussed a very small point at the time of explaining the accounting treatment in the books of selling company. But here in detailed discussion we are going to make. Concentrate, guys. I'll put all the possibilities in a single diagram. I'll represent the information in the diagrammatic representation. The first and foremost case, liquidation expenses are incurred by selling company. Sir, in generally, the liquidation expenses of the selling company in generally belongs to the selling company. Most of the cases, such liquidation expenses are incurred by themselves, and such expenses are paid by themselves itself. But certain point of time, incurred by selling company, but reimbursed by the purchasing company at later point of time. Incurred by the selling company and reimbursed by purchasing company at later point of time. And the last situation, the possible situation is those are directly incurred by purchasing company. Even though really those are related to the selling company, but purchasing company make a promise that, okay, no worries, I will along with taken over of assets and liabilities, I also incurred your liquidation expenses on behalf of you. That is the promise given by the purchasing company. Total 3 situations are possible. Sir, in all these 3 situations, what is the accounting treatment in the books of purchasing company, what is the accounting treatment in the books of selling company? Let us see one by one. In the books of selling company, let us assume incurred by selling company. We already discussed the accounting treatment in the books of selling company. Can you please tell me what is the accounting treatment in the books of selling company? Realization account at R2 cash account. The original entry is liquidation expenses to cash. Now we are in the books of the selling company. Whatever the expenses or income arised in the process of liquidation, it should need to transfer to which account? Realization account. That's why the entry is realization account at R2 liquidation expenses. Now liquidation expenses cancel with each other. The net entry is realization account at R2 cash account. That is the entry in the books of selling company. Sir, at that point of time, what is the entry in the books of purchasing company, sir? Sir, selling company expenses incurred by the selling company. And what is the pain to the purchasing company? There is no entry in the books of purchasing company at that particular scenario. The reason is such expenses are incurred by whom? Selling company. Such expenses belongs to whom? Selling company. There is no relevance or there is no relation to that particular expenses as well as purchasing company. That's why no entry. Next, coming to the second situation, guys, all of you. What is the second situation? Can you please tell me, all of you? Incurred by the selling company first. At later point of time, such expenses are reimbursed by whom? Purchasing company. Now, sir, at the time of incurrence of expenses by the selling company, at the first instance, what is the entry? The same entry. What is that? Cash is an outflow to cash account. No doubt about it. I can put the realization debit if nothing I unable to recover from, if nothing is recovered from purchasing company. But here in this situation, in future, I am going to recover such amount from whom? Purchasing company. That's why purchasing company is debtor to me. I need to recover such amount from the purchasing company. That's why the entry is purchasing company account debtor to cash account. Sir, at later point of time, if you realize that cash from the purchasing company, what is the entry, sir? Cash account debtor to purchasing company. Such a simple journal entries. You may ask that, sir, the impact is there is no impact or the impact is nil. Yes, absolutely, you are correct. But such two transactions are occurred at two different time intervals. That's why we are going to record such entries in the books of selling company. At the time of incurring the expenses, which is purchasing company to cash, at the time of receipt of reimbursement, the entry is cash to purchasing company. That is accounting treatment in the books of selling company. Hope you understand. Sir, now coming to the accounting treatment in the books of purchasing company. Sir, is there any relation between such expenses as well as purchasing company in this situation? Yes. The impact is cash outlay is there. At the time of reimbursement, cash outlay is there. So definitely to cash account is the credit component. Now, what will be the debit component? Sir, apart from takeover of assets and liabilities, you are promised to pay excess money in the form of reimbursement, right? Whenever you are paying the excess money over the worth taken, that excess is for the purpose of, tell me guys, goodwill. Why you are paying the excess amount right now? For the purpose of reimbursement, that is to retain the goodwill, to getting certain goodwill. So selling company is having certain goodwill, that's why I'm paying. That's why the entry is goodwill accounted to cash account. That is the impact in the books of purchasing company. Next, sir, coming to the last situation, guys. Final situation. What is the final situation? Incurred by purchasing company directly. Incurred by purchasing company directly. So then in the books of selling company, no entry. Why, sir? Purchasing company themselves promised to incur such expenses. Then there is no relevance in my books of accounts. That's why there is no entry. Now coming to the books of purchasing company. What is the entry? I promised to pay excess money over the worth. Get it right? So that's why which is goodwill to cash. Goodwill accounted to cash account as like this only. The same entry we need to pass. So here the overall theme or the overall process here, what I want to try to explain. Whenever the liquidation expenses are ultimately incurred by the selling company in the books of selling company, the entry is realization account to cash account. At that point of time in the books of purchasing company, no need to pass any entry. Sir, incurred by the selling company first. At later point of time, such expenses are reimbursed by the purchasing company. Then in the books of selling company, at the time of incurring of expenses, purchasing company to cash. At the time of getting reimbursement from the purchasing company, entry is cash to purchasing company. Then in the books of purchasing company, it was promised to pay this amount over the worth get it. That's why it should need to debit the goodwill account. So the entry is goodwill account at R to cash account. Those are ultimately incurred by the purchasing company, which is the last situation. Then in the books of selling company, no entry. In the books of purchasing company, the same entry, it is going to pass, which is goodwill to cash account. Hope you understand everything here, right? Fine, guys. Sir, with this, we successfully completed the concept related to the entire chapter amalgamation. Sir, without wasting much time, first let me take up a good problem, because till now we are seeing the entire concept periodically. Now let us check the concept with the problem, whether we can able to apply the concept we learned till now to a particular problem or not. We can check through problem number 1. Guys, one more thing regarding my material. My material is completely based upon our ICA resources only. So which is very much strategically designed, the level or the order in which the problems we need to give, the concept we need to give, the same content which is there in the ICA material as it is I given, but in a strategical order, by making small corrections and by making small changes for the purpose of benefit of the students. That's why you can simply follow the my material as a final material for your examinations as well for these chapters. And I am also giving one promise to you. At the end of my sessions, I will also upload my entire material for group 2 advanced accounting. For my entire material also I'm going to upload. If any of the students, if they want to follow, they can simply follow the material as well. Because I took a lot of efforts to develop this material. Almost I took 2 to 3 months time, and especially I developed each and everything. So many students are also following the same material. If you want, you can also follow. Yeah, fine. Come to problem number 1, guys. All of you, please come to problem number 1. Before proceeding with problem number 1, let me check some queries are there. Sir, why is incurred by purchasing company? No entry. This belongs to selling company. You need to understand one thing. Those are belongs to selling company only. But purchasing company clearly told that realization expenses is my headache, or liquidation expenses are my headache. No worries, just you can simply ignore. Then at that point of time, I means as a selling company, I also decided that, okay, there is no relevance with such expenses. Those are clearly intimated by the purchasing company. So that's why purchasing company will take care about that. That's why those are not my expenses right now. Due to terms and conditions entered in between purchasing company and selling company, such issues may agree. One more question asked by Hariram. Sir, in the books of purchasing company, now goodwill is arised. Can we make set off with capital reserve? Absolutely, ma. If capital reserve is there, you can set off with the goodwill. No issues at all. Okay. Sir, one doubt. This is also by Shriram. If liquidator is appointed for selling company, the company needs to pay some remuneration to the liquidator. How to make such payment of remuneration to the liquidator? Sir, here in this case, that liquidator remuneration is also form part of liquidation expenses. Liquidation expenses means what are all the realization expenses, or liquidator remuneration, or any marketing expenses, all such issues are added. Liquidation expenses itself includes liquidator remuneration as well. Okay, fine. Sir, question number 1 is done. Rahul, we previously done question number 2, not question number 1. Okay, question number 2 is PC. Question number 1 is a comprehensive problem. Please, all of you concentrate on question number 1, guys. Y Limited acquires the business of Z Limited. Y Limited acquires means Y Limited is a purchasing company. Z Limited is a selling company. Whose balance sheet as of 31st March 2011 is as under. So a typical Schedule 3 format of balance sheet, a typical balance sheet of the corporate, equity and liabilities, under shareholders funds, share capital. If you observe under note number 1, share capital consisting 2 different types of capitals. One is equity share capital, another one is 6% preference share capital. 2 different types of capitals are possible in this company. Next, coming to reserves and surplus. If you go to note number 2, what are all the different reserves exist? We can have a look. Capital reserve, profit and loss account, workman compensation reserve. Under bracket, they clearly given that expected liability rupees 5,000. What is the meaning of this issue, sir? Whenever expected liability out of such reserve is possible, whenever they're given like that, out of this 8,000, you can simply treat that 5,000 as liability. Because out of the reserve, if there is any expected liability is there, they are directly providing a hint that the entire 8,000 will not be considered as a reserve, out of which 5,000 you can consider as a liability. What about the remaining 3,000, sir? Remaining 3,000 you can consider it as a workman compensation reserve. That means indirectly they are telling that workman compensation reserve is only 3,000. This 5,000 is liability. Sir, when this will occur, I will tell you. Whenever in an organization, if any labor or if any employee is having disability or maybe injured during the process of providing the official duties, at that particular point of time, as per the Workman Compensation Act, we need to compensate such workman because those are the labor, they are under the process of manufacturing. At that particular point of time, we will utilize the reserve amount. So now, as per such act, it will become as a liability. So that's why which is 5,000 is a liability, 3,000 is a workman compensation reserve. That is the meaning of expected liability. Okay, come up, guys. Then coming to non-current liabilities, long-term borrowings are there. Note number 3, under long-term borrowing, 6% debentures exist. Next, coming to current liabilities, trade payables is there. Other current liabilities, which is interest payable on debentures, which is nothing but outstanding interest on debentures. Okay, this is total of liabilities. Coming to assets, under non-current assets, property, plant and equipment is there. Note number 4, PPE, land and building is there. Plant and machinery is there. Next, under intangible assets, just now we seen goodwill and patents are there. Okay, fine. Next, current assets, inventories are there, trade receivables, cash and cash equivalents. These are the total assets components. Next, Y Limited was to take over, Y Limited means purchasing company, was to take over all assets except cash. Can you please tell me, all of you guys, if purchasing company is ready to take over some of the assets, not all the assets, then the amalgamation is in the nature of purchase or amalgamation in the nature of merger. Except cash. Cash is not taken over by the purchasing company. By seeing this point, we can simply decide that amalgamation is in the nature of purchase. Because the amalgamation said to be amalgamation in the nature of merger, all the assets and liabilities of the purchasing, all the assets and liabilities of the selling company should be taken over by purchasing company. And the liabilities, except for interest due on debentures. This outstanding interest is there, na? The outstanding interest is also not taken over by the purchasing company. That means one asset, one liability is not taken over by the purchasing company. And to pay the following amounts. What are such different amounts? Rupees 2 lakhs face value, 7% debentures in Y Limited for the existing debentures in Z Limited. For the purpose, each debenture of Y Limited is to be treated as worth rupees 105. What they are telling indirectly, in selling company, debentures are exist na. In selling company, 6% debentures are there na. 2 lakhs worth of face value. For such 2 lakhs worth of face value, purchasing company, that is Y Limited, going to issue their own debentures. That is 2 lakhs face value, 7% of debentures. But the each and every debenture, they are treated as a worth of 105. 105 means, can you please tell me, all of you, 2 lakh into 105% means, which are 2 lakh 10,000. For 2 lakhs worth of face value of debentures, we are issuing 2 lakh 10,000 worth of debentures means, the agreed value of the debentures are more than at face value. The agreed value of the debentures, not at 2 lakhs, the agreed value of the debentures at 2 lakh 10,000. And one more point here I want to tell you, which is not form part of PC. Amount payable to the debenture holders of the selling company is not form part of PC. This is only for knowing the agreed value of the debentures taken over by the purchasing company is at 2,10,000. Okay, wait. For each preference share in Z Limited, we are paying 10 rupees in cash. Please let me know, all of you, how many preference shares are there? 4 lakhs worth divided by 100 means 4,000 preference shares. For each preference share, we are paying 10 rupees in cash. 4,000 into 10 means 40,000. And 9% preference share of 100 each in Y Limited. For 1:1 ratio. For each preference share in selling company, we are issuing our own company preference share. So 4,000 preference shares into 100, which is 4 lakhs. So the amount, total amount payable to preference shareholders are 40,000 plus 4 lakhs, which is 4 lakh 40,000. Next, coming to point number C, all of you. For each equity share in Z Limited, we are paying 20 rupees in cash. How many number of equity shares are there, guys, here? 8 lakhs divided by 100 means 8,000 equity shares are there. 8,000 equity shares into 20 rupees. How much? 8,000 into 20 is nothing but 1 lakh 60,000 in the form of cash. And one equity share in Y Limited of rupees 100 each, having the market value of 140. Again, 1:1 ratio. 1:1 ratio means again we are going to issue 8,000 equity shares in our company, but each and every equity share we are issued at 140. Face value is 100, but we are issued at 140. 8,000 into 140 is how much? Which is 11 lakh 20,000. Now, can you please tell me, all of you, what is the method of PC? Method of PC, all of you, please tell your answers under the query box. Please put your answers under the query box, guys. Quickly, what is the method of PC? Is it net asset value method or net payment method or intrinsic value method? While reading the problem, while reading the information given in the problem, if you are able to know how much amount payable to equity shareholders and preference shareholders of the selling company, then method of PC will be net payments method. Can you please tell me, all of you, what is the amount of PC total? Here 4,40,000. 4,40,000, which is amount payable to preference shareholders, plus 1,60,000 plus 11,20,000. So the total amount of PC is 17,20,000. Am I right? PC is 17,20,000. Fine. Next, all of you, please come to point number D. Expense of liquidation of Z Limited are to be reimbursed by the Y Limited to the extent of 10,000. Actual expenses amounted to 12,500. Just now we completed the liquidation expenses concept. Here it is clearly given that the total liquidation expenses were 12,500. Out of which 2,500 incurred and paid by the selling company themselves. That is situation number 1. Remaining 10,000 expenses first incurred by the selling company, at later point of time reimbursed by the purchasing company. If selling company incurred by themselves, then the entry is realization to cash in the books of selling company. Then in the books of purchasing company, no entry at that point of time. Now, incurred by the selling company, but at later point of time reimbursed by the purchasing company. Then in the books of selling company, 2 entries. What is the first and foremost entry? Purchasing company to cash. And the next point of time, cash to purchasing company. So then in the books of the selling company, in the books of the purchasing company, what is the entry? Goodwill to cash. That point you should need to remember. That is the impact of point number D. Hope you understand. Next, come down. Y Limited. Y Limited means purchasing company valued land and buildings at 5,50,000, which is agreed value. Agreed values are taken over values. Plant and machinery at 6,50,000 and the patents at 20,000 of Z Limited for the purpose of amalgamation. Sir, for which purpose this information is given, sir? To know the NAV, net asset value. Net asset value of the business takeover in the books of purchasing company at the time of incorporation of assets and liabilities, we should need to compare PC with NAV. Na? These are useful for NAV. Sir, accept these values, accept these assets. At which value the remaining assets and liabilities we are taken over, sir? If nothing was mentioned, We are taking over the remaining assets and liabilities at book values only. Why this information is specially given? Why the for other assets and liabilities information is not given? If nothing is given means we are ready to take over at book values only. If something is given, we should need to take over at that specific values. Now, what are the requirement? Calculate the purchase consideration. Actually, we already completed in very layman approach, which is 17,20,000. We need to put in our notes as well. Next, provide the journal entries in the books of vendor company. Vendor company means selling company, and also provide the closing ledgers. I will not provide the entries. I will directly go with the ledgers, because if you are able to complete the ledgers, automatically you know the entries. Provide the journal entries in the books of purchasing company. I'll provide the entries in the books of purchasing company. Am I right, guys? All of you with me? Now, please concentrate. Let me open my OneNote quickly, which is problem number 1. Please concentrate, guys. Sir, to save my time, certain things I will put under in shortcuts. Please, all of you follow. So the first and foremost question is calculation of PC, right? Can you please tell me, all of you, which method we are following? Net payments method. How we need to calculate under net payments method? So which is particulars amount rupees. First, we can start with amount payable to equity shareholders. You can start with amount payable to equity shareholders. Amount payable to equity shareholders in two different forms. One is cash. Cash in the form of cash. 8,000 shares multiplied with 20, which are 1,60,000. Next, in the form of equity shares. In the form of equity shares, 8,000 into 140, which are 11,20,000. So total 12,80,000 is the amount payable to equity shareholders. Am I right, guys? Next, coming to preference shareholders. So for preference shareholders, cash is how much? 4,000 multiplied with 10, which is 40,000. In the form of preference shares, how much? In the form of preference shares, 4,000 into 100, which is 4 lakhs. So total 4,40,000. So the total amount of PC is 17,20,000. Like this, you need to present the PC. Okay, fine. Calculation of PC is over. What is the next question they asked? Question number 2, accounting treatment in the books of selling company. All of you, please follow me. How many steps approach? 5-step approach. AS14 applicable? No, gap is applicable. So all of you, one by one step, we need to apply. Step number 1, dismantling of the balance sheet. In case of dismantling of the balance sheet, what we should need to do? Assets and liabilities which are taken over by the purchasing company should be closed and transferred to which account? Realization account. That's why you can open realization account. All of you quickly. Realization account first you can open. Under 5-step approach, we are at step number 1. We are in the process of dismantling of balance sheet. Sir, if any of the specific asset or liability which is not taken over, also you need to open separately. Out of this, outstanding interest on debentures not taken over. And one more thing, cash is also not taken over by the purchasing company. That's why cash account and outstanding interest on debentures, you can open separately. So here I'll open cash account. And you can also open outstanding interest account. Fine. One more thing, guys. Here, share capital having two different components. One is equity share capital, another one is preference share capital. That's why you need to open equity shareholders account as well as preference shareholders account. Please let me open such accounts as well. equity shareholders account. This is preference shareholders account. So this is preference shareholders account. Is it okay, guys? Next. Now, just now we opened. Now start process of dismantling. What are all the different assets taken over by the purchasing company should be closed and transferred to realization account at which values? Book values. Coming to the assets, land and building is there. PPE, realization to land and building. How much at book value? 4 lakhs. Next, plant and machinery is there, 6 lakhs. Next, after PPE, intangible assets are there, goodwill and patents. So goodwill is taken over, 2,40,000. Patents, 50,000. Some student may have a doubt that, sir, land and building and plant and machinery are taken over at other than book value. Now, why you are transferring to book value? We are in the books of selling company, guys. To close a particular account, the assets and liabilities which are taken over by the purchasing company, we should need to close and transfer to realization account at which values? Book values only. Sir, after PPE and intangible assets, coming to current assets, inventory 1,50,000. Inventory 1,50,000. After inventory, trade receivables are there, 1,80,000. Is it cash is taken over by the purchasing company? No. That's why we separately opened two balance brought down, 70,000. Assets total over. Coming to liabilities, guys. Outstanding interest on debentures not taken over. That's why separately opened by balance brought down, 12,000. Don't transfer to realization. Outstanding debentures. Next, coming to other liabilities, debentures are there for 2 lakhs. Trade payables are there for 1,20,000. Debentures, how much percentage debentures? 6% debentures. So 6% debentures, you can transfer to realization, 2 lakhs. Next, trade payables, 1,20,000. Hope all the assets and liabilities with dismantling is over. Now coming to preference share capital. Preference share capital is how much, guys? 4 lakhs. By 6% preference share capital, 6 lakhs. Next, coming to equity share capital, 8 lakhs. By equity share capital, 8 lakhs. Apart from the equity share capital, what are the different amounts we have under reserves and surplus? Also, we need to make it transfer to whom? Equity shareholders. But here you should need to remember one thing. Out of the workman compensation reserve of 8,000, the real reserve is only 3,000 and the remaining 5,000 is liability. So the reserves and surplus balance is 1 lakh capital reserve, P&L 50,000, 3,000 only workman compensation reserve you should need to consider. Now, under equity shareholders, by reserves and surplus, capital reserve 1 lakh, P&L 50,000, workman compensation reserve only 3,000. Sir, what about remaining 5,000, sir? If nothing is mentioned means which is liability, that liability is also taken over by whom? Purchasing company. How you know, sir? They are not mentioned clearly, na? But they mentioned one point. What they mentioned, they are ready to take over all assets, all liabilities, except this. Except this means this workman compensation liability is also taken over by whom? Purchasing company. That's why any of the liability which is taken over by the purchasing company should be closed and transferred to realization. Workman compensation liability 5,000, you can make it transfer to realization. Hope you all of you understand this point. Out of this 8,000, 5,000 is a liability, 3,000 is a reserve. That's why 3,000 transfer to equity shareholders account, 5,000 transfer to realization. Except this, any other fictitious assets are exist? No. I think so. Each and every component of the balance sheet got dismantled into different accounts right now, which is step number 1. Coming to step number 2. What is step number 2? PC due. So just now we completed step number 1, which is dismantling of balance sheet. Now come to step number 2, which is PC due. What is the due entry for PC? Purchasing company account to realization account. In realization, by Y Limited at the rate of PC. We already calculated the PC under the first question, under the first sub question, which is 17,20,000. But in generally, we are providing it as working note. But in this problem, they clearly asked to calculate the PC. That's why we already done with PC. So by Y Limited 17,20,000. Then where is the Y Limited account? Not exist. That's why you can open Y Limited account as well. Y Limited account in bracket purchasing company. Please, all of you follow my flow, guys. I'm little bit speed at the time of resolving the problems to save my time. Anyway, I'm recording each and everything for your better understanding as well. Then in realization by Y Limited means then in Y Limited to realization. To realization 17,20,000. Step number 2 is over, right? PC due over. Come to step number 3. PC receipt. Sir, in the form of PC, what are all different components you are getting? Please, all of you consider here. Out of this 17,20,000, cash component is 40 plus 1,60,000. Cash component is 2 lakhs you are getting. In the form of equity shares, they are getting 11,20,000. In the form of preference shares, they are getting 4 lakhs. Now the entry, cash account at R, equity shares of Y Limited account at R, preference shares of Y Limited account at R to Y Limited account. So in Y Limited, by cash how much we got? Just now I wrote 2 lakhs. By cash 2 lakhs. By equity shares of Y Limited. How much, guys? Equity shares of Y Limited 11,20,000. 11,20,000. Next, by preference shares of Y Limited 4 lakhs. Now the simultaneous posting also you should need to provide in Y Limited, that is by cash, in cash to Y Limited, which is 2 lakhs. We can also open equity shares of Y Limited as well as preference shares of Y Limited to other accounts. Equity shares of Y Limited you can open, then preference shares of Y Limited also you can open. So can you please tell me, guys, all of you, in Y Limited by equity shares means in equity shares to Y Limited 11,20,000. In Y Limited by preference shares means in preference shares to Y Limited, which are 4 lakhs. Sir, we are in which step, sir? Can you please tell me, sir? PC received. PC due, you wrote PC received. At the time of PC receipt, cash account at R, equity shares of purchasing company, preference shares of purchasing company to purchasing company. That entry only I made. Next, step number 4, PC distribution. Sir, along with the PC, what are all the different resources you have? You can check. Now, along with the PC of 17,20,000, I also have the cash component of 70,000. Now, how I need to distribute? I need to distribute first realization or liquidation expenses, then secured creditor, then unsecured creditor, then preference shareholders, then equity shareholders, out of which first we need to make payment for liquidation expenses. Can you please tell me, all of you, in the problem, we already discussed the accounting treatment for liquidation expenses. As a selling company, in our own hands, how much expenses we are going to incur? 2,500. What is the entry? Realization to cash. Now, realization to cash means in realization to cash account, 2,500. In realization to cash means in cash by realization, 2,500. Are you with me, guys? All of you, the same flow you can follow, automatically you will get the answer. Next, what about remaining 10,000 in the books of the selling company? First, it will incur purchasing company to cash. At later point of time, it will receive cash to purchasing company. There is no impact. To save my time, just I'm ignoring. But in the examination, you can put it, guys. Don't ignore. The impact is nil here. That's why I'm not considering right now to save my time. purchasing company to cash, cash to purchasing company will nullify with each other. That's why regarding this 10,000, I don't want to write any journal entries, just leave as it is. So then after liquidation expenses or the realization expenses, next I need to make payment to secured creditor. There is only one liability is left over by the purchasing company, which is outstanding interest on debentures. Outstanding interest on debentures is an secured or unsecured, I don't know, but there is only one liability is there. You can make payment to the outstanding interest because there is no information provided in the problem whether it is secured or unsecured, but you can make it direct payment to the outstanding interest, that is to cash account. How much? 12,000. If nothing was mentioned means the same book value only we are giving to that particular liability. You can cross check here. 12,000. Fine. Outstanding interest to cash, then in cash by outstanding interest. Don't write the simultaneous posting. Don't forget to write the simultaneous posting. Otherwise the problem doesn't match. Okay. So in cash by outstanding interest is over. Next, sir, in the order after liquidation expenses and secured and unsecured creditors, the next preference shareholders. Sir, two preference shareholders, we are issuing two different components. Cash is 40,000. Preference shares of the purchasing company 4 lakhs. Please issue the same amount to the preference shareholders. Where the preference shareholders exist? Here. Preference shareholders to cash. So cash is here 40,000 to preference shares of Y Limited 4 lakhs. 4 lakhs or how much, guys? Yeah, 4 lakhs. Correct. This is 4 lakhs and 40,000. What is the outstanding balance of preference share capital? This is 4 lakhs. Sorry. This is 4 lakhs. Now, can you please all of you tell me here, in preference shareholders account, to the preference shareholders, we need to pay 4 lakhs. But we paid 4,40,000. Excess how much we paid? 40,000 we paid, which is loss, right? The loss should we need to transfer to realization account. That point also, please remember all of you. While settling amount to the different parties, if you are getting any profit or loss, such profit or loss also you should need to make transfer to realization. In preference shareholders by realization means in realization to preference shareholders account. That is 40,000. Next, one more thing, guys. In preference shareholders to cash means in cash by preference shareholders. 40,000. Simultaneous posting. In preference shareholders to preference shares of Y Limited means in preference shares of Y Limited by preference shareholders account 4 lakhs. With this, preference shareholders account got closed. Next, for all the parties, payment is over except to the equity shareholders. Before making final settlement to the equity shareholders, first you should need to close realization account. Can you please close all of you the realization account? Let me know the profit or loss situation. Please, all of you participate, guys. Please. Please, all of you, let me know the realization profit or loss is how much. Sir, somebody is telling that, sir, speed is a little bit high, sir. Please slow down, sir. Okay, my dear. I'll take it into consideration. But just I am bothering about whether we can able to cover all the problems or not. That's why I know it is a little bit speedy, but no worries. Anyway, once the problem is over, I'll summarize for your purpose once again. Okay. Let me take the step right now itself. Let me summarize the things till now what I have discussed in the problem. Please, all of you concentrate, guys. 1 second. Yeah. Sir, this is only 5-step approach. In step number 1, simply dismantling of balance sheet occurred, which is what are all the different assets taken over? That is land and building, plant and machinery, goodwill, patents, inventory, trade receivables. Just I make it transfer to realization at book values. In the same way, liabilities, 6% debentures, trade payable and workman compensation liability also transfer to the realization. Cash not taken over, separately opened. Next, outstanding interest not taken over, separately opened. Preference share capital transfer to preference shareholders account. Equity share capital transfer to equity shareholders account. The reserves and surplus, capital reserve, P&L, workman compensation reserve to the extent of 3 lakhs transferred to equity shareholders account. Dismantling of balance sheet over. Step number 2, PC due. What is the entry for PC due? Purchasing company accounted are to realization. That is Y Limited to realization. In realization by Y Limited. Then I opened the Y Limited account to realization. Step number 2 is over. Next, come to step number 3. PC receipt. What are all the different components you are received in the form of PC? Cash total 40,000 plus 1,60,000. In the form of cash, you received 2 lakhs. In the form of equity shares, you received 11,20,000. In the form of preference shares, you received 4 lakhs. That's why at the time of receipt of PC entries, cash account that are 2 lakh, equity shares of Y Limited 11,20,000, preference shares of Y Limited 4 lakhs to Y Limited. The same entry I posted in Y Limited by cash, by equity shares of Y Limited, by preference shares of Y Limited. Simultaneous posting also I given under cash to Y Limited 2 lakhs. Under preference shares of Y Limited by under preference shares of Y Limited to Y Limited. Under equity shares of Y Limited to Y Limited. Do you understand? Next, after receipt of PC, the distribution of PC should need to occur in a particular order. First we incur the liquidation expenses. Further, the entry is realization to cash. Realization to cash 2,500. What about remaining 10,000? First incurred by us, later point of time reimbursed. That's why there is no impact for such 10,000. That's why I simply ignored. Then secured creditors or unsecured creditors, only we are having one liability which is left over by the purchasing company. That's I paid outstanding interest to cash. That's why in cash by outstanding interest. In the next level of order, I need to make repayment to preference shareholders. So the outstanding liability for preference shareholders was 4 lakhs, but here we are paying in the form of cash 40,000, in the form of preference shares 4 lakhs. The excess amount paid over the existing liability is a loss. Such a loss we need to make it transfer to realization account. In preference shareholders by realization, in realization to preference shareholders. At the time of making settlement, preference shareholders to cash to preference shares of Y Limited means in cash account also simultaneous posting you need to do. In preference shares of Y Limited also you should need to give simultaneous posting. Are you with me, all of you till now? Tell me, guys. Before making final settlement to the equity shareholders, first I should need to close the realization account. Can you please all of you close the realization account? May I know the realization profit or loss? Quickly, guys. So many persons are giving different answers. Let me check from my end as well. It's 3,82,500. Am I right? It's 3,82,500. Which side it is coming, guys? This side. Balancing figure is coming under which side? Under debit side, it is coming balancing figure. So which is profit, right? If this side it is coming, which is profit, that is to equity shareholders account. So in realization to equity shareholders, then here equity shareholders also by realization account. 3,82,500. If you observe, with this realization account got closed. Outstanding interest account already closed. Preference shareholders account closed earlier. Y Limited account closed earlier. Preference shares of Y Limited account also closed earlier. Now, if you observe, we are only having 3 accounts. One is equity shareholders account. Another one is cash account. Another one is equity shares of Y Limited account. Only these 3 accounts we have. Out of which equity shares of Y Limited as well as the cash component, we need to make payment to whom? Equity shareholders. Can you please check, all of you, how much amount is outstanding? That is how much amount is payable to equity shareholders total. Can you please check? 8 lakhs plus 1 lakh plus 50,000 plus this workman compensation reserve is 3,000, guys. This is only 3,000. plus 3,000 plus 3,82,500. Total I need to pay 13,35,500. 13,35,500 I need to make settlement to the equity shareholders. Do you have this much of resource with you? Let me check. In the form of equity shares, I have 11,20,000. In the form of equity shares, I have 11,20,000. How much cash component you have with you? 2,70,000 minus 2,500 minus 12,000 minus 40,000. I have 2,15,500 cash component. Cash is 2,15,500. Total is how much? Can you please check? Exactly matched. Exactly matched. What is the meaning of that? You know, I am paying in the form of cash 2,15,500 in the form of equity shares of Y Limited. I am paying 11,20,000. With that, equity shareholders account got closed. With that, equity shareholders account got closed. In equity shareholders to cash means in cash by equity shareholders. 2,15,500. Then cash account automatically closed. If you can check here, that amount also we are paying to equity shareholders. So equity shares of Y Limited also closed. Then if you observe, all the ledgers in the selling company got closed. If there is no balance means then only books of accounts closed. If it is not got closed, some balance is appearing means your books of accounts not got closed. Do you agree with me, all of you guys? Such a simple accounting treatment you need to adopt in the books of selling company. No confusion, only 5-step approach, dismantling of balance sheet, assets and liabilities which are taken over by the purchasing company, closed and transferred to realization at book value, asset or liability which is not taken over by the purchasing company separately open, preference share capital transferred to preference shareholders, equity share capital and reserves and surplus transferred to equity shareholders account. Dismantling over. PC due entry, purchasing company to realization at the rate of PC, PC receipt entry, what are all the different components you are receiving from the purchasing company, cash, preference shares of purchasing company accounted are, equity shares of purchasing company accounted are to purchasing company, then the received PC along with the existing cash resources, you can distribute in the particular order, liquidation expenses, secured creditor, unsecured creditor, preference shareholders, and during this process, if you are getting any profit or loss, you can make it transfer to realization. Before making final settlement to the equity shareholders, first you can close the realization account, profit realization to equity shareholders, loss equity shareholders accounted are to realization. After transferring realization profit or loss to equity shareholder, make final settlement to the equity shareholder with the available resources in your hand, then automatically all accounts got closed. That's it, guys. Someone, Hariram is again asking, sir, please explain the last part again related to equity shareholders account. Nothing, my last part always you should think in this way. To settle the equity shareholders, what are all the different components we have? To settle the equity shareholders, we have the cash component of 2,15,500. To settle the equity shareholders, we are also having equity shares of Y Limited for 11,20,000. Just to make it transfer that resources to the equity shareholder, I transferred 2,15,500. I also transferred 11,20,000 among the equity shareholders. Just I distributed among the equity shareholders. Then automatically equity shareholders account got closed. That's it. Nothing is great here. Do you understand? Nobody is responding here. Please, all of you quickly respond. And one more thing, guys, the same issue I was already clearly put it in my notes as well. If you check here, no worries. Which is problem number 1, calculation of PC part. I was done in my notes clearly with a beautiful presentation and closing the ledger books in the books of Z Limited. If you observe here, I clearly recorded, noted up to this. Okay, sir, if you are unable to reach my speed and recording here and there, don't be confused. So just listen the class at the time of doing the problem. At later point of time, you can follow my notes. I already uploaded, and today one more time I'm going to upload as well. Okay, Can I continue my flow, guys? All of you? Okay, fine. At this stage, we can do one thing. I know so many persons are waiting for break, like anything. The time is exactly 8:25. Please, all of you assemble by 8:35. Then we can continue till 9:30. Accounting treatment in the books of purchasing company is still pending in this problem. Once the break completed, we are going to take accounting treatment in the books of purchasing company. Is it okay, guys? Please, all of you go for break. Yes, welcome back. Now we can concentrate on accounting treatment in the books of purchasing company. So if you observe here, out of the three requirements, we already completed requirement number 1 and requirement number 2. Now the pending issue is provide the journal entries in the books of purchasing company. Now, can you please tell you, all of you, in the books of purchasing company means Y limited books. Y limited books. Is it AS14 is applicable or not? AS14 is applicable. If AS14 is applicable, what you should need to think from your side? First, type of amalgamation. What is the type of amalgamation here? Even though in the problem, they are not mentioned specifically, based upon the information given in the problem, we already decided the type of amalgamation is amalgamation in the nature of purchase. Amalgamation in the nature of purchase. Then what is the method of accounting treatment we need to follow? Method of accounting treatment. Purchase method. Whenever you are providing the accounting treatment in the books of purchasing company, first you should need to decide these things. Then start writing the journal entries as per the requirement. What is the first and foremost journal entry? For business purchase. Business purchase account data to liquidator of Y Limited. Sorry, liquidator of Z Limited, which is selling company. Liquidator of Z Limited account at the rate of PC. PC is how much? 17 lakh 20,000. Am I right, guys? PC is how much? 17 lakh 20,000 only, right? Fine. Next, the second entry is incorporation of assets and liabilities. What are the different assets actually we are ready to take over? But here you should need to remember assets taken over at the rate of agreed value, you should need to incorporate. Check one by one. We are taken over all the assets except cash. It have under PPE two different components. One is land and building and plant and machinery. Agreed value is also given. So land and building taken over at 5,50,000. 5,50,000. Okay. Then plant and machinery is at 6,50,000. Then coming to intangible assets, patents at 20,000. Patents at 20,000. Apart from the patent, one more intangible asset is there. That intangible asset is taken over. That is goodwill. Goodwill at 2,40,000. Goodwill is at 2,40,000. Next, come to the other assets. Inventory, nothing was given means at the book value only, which is 1,50,000. Trade receivables 1,80,000. These are the different assets taken over by the purchasing company. Cash was not taken over, right? 2. Coming to liabilities, guys. Liabilities, may I know one by one? Outstanding interest on debentures not taken over. Trade payable taken over, which is 1,20,000. Next, long-term borrowings, which are debentures. Can you please tell me, all of you, these 6% debentures of the Z Limited, we are taken over at 2,10,000. The agreed value of the debentures, we are taken over at 2,10,000. At the time of reading the problem under point number A itself, I clearly established that fact, right? For 2 lakhs face value of 7% debentures in purchasing company for the existing debentures in selling company. For the purpose, each debenture of the purchasing company is to be treated as worth 105. That means we are ready to take over the debentures of the selling company at the rate of 2,10,000. That's why you need to write 6% debentures in Z Limited. Don't simply write 6% debentures because you are in the books of purchasing company. You should clearly write 6% debentures of the selling company or 6% debentures of Z Limited. At which value, guys? 2,10,000. Now, can you please cross check all of you? Only these are the liabilities taken over. Apart from that, any other liability exist? Long-term borrowings over, trade payable, other current liabilities not taken over. Now, you should need to cancel business purchase. You should need to cancel business purchase to business purchase, which is nothing but PC 17,20,000. Now, all of you please observe here, we should need to compare PC with NAV. Sir, is there any chance of occurring goodwill or capital reserve? Yes, because here the PC is under net payments method. If the PC is under net payments method and the PC is 17,20,000. And may I know the net asset value? Net asset value is nothing but total of the assets minus outside liabilities. Total of the assets how much? 5,50,000 plus 6,50,000 plus 20,000 plus 2,40,000 plus 1,50,000 plus 1,80,000. Total of the assets are 17,90,000 minus 1,20,000 minus 2,10,000. That is 14,60,000 is the worth of NAV. Am I right, guys? Can you please check all of you? PC is greater than NAV. If PC is greater than NAV, then which is the goodwill situation? May I know the goodwill is how much? 17,20,000 minus 14,60,000. Goodwill is 2,60,000. Am I right, guys? All of you? Are you getting the goodwill same amount for you as well? Goodwill is 2,60,000. Different persons giving different answers here. Someone is giving 1,46,000. Other one is giving 2,65,000. Someone is giving my component 2,60,000. Guys, can you please let me know? Is it 2,60,000 is fine? That's great. I ignored one liability. That's great. Workman compensation liability. Super. 2 workman compensation liability. Please consider. That's correct. How much it is? Workman compensation liability is how much, guys? 5,000. That one also you need to incorporate. Then, which is not 14,60,000. I think so, which is 14,55,000. Right? Now 17,20,000 minus 14,55,000. 2,65,000 is correct. You are right. The person who told 2,65,000 in the query box is correct. All right. 2,65,000 is correct, right? Fine. That's great. Now consider it, all of you. Here goodwill is 2,65,000. Already goodwill of the selling company exists. Already goodwill of the selling company exists. If you write again one more time goodwill, double time recording of the goodwill happen. It's for looking, it's look like odd. Then what you can do here, the goodwill is 2,40,000 plus 2,65,000. Total how much? 2,40,000 plus 2,65,000. Total is how much, guys? 5,05,000. Just I'm rubbing this. I'm recording this is 5,05,000. Sir, you are in the recording mode. That's why simply you are rubbed it, you are recorded it. But in the examination, if we did like this, then again we need to cross it. Again we need to record now. Then what we can do, sir? You can simply do one thing. Whenever, please all of you consider this point. Whenever purchasing company is ready to take over the assets of the selling company, out of that asset, goodwill is also one of the component. Then don't incorporate goodwill directly. Don't incorporate goodwill directly. Put the goodwill amount as pending. Write the goodwill, but don't put the figure. At the end of comparing the PC with NAV, if any goodwill component is coming, at that point of time, along with the goodwill of the selling company and goodwill while comparing with PC with NAV, you can club both. Then you can record. That point you should need to remember in your mind. Is it okay, guys? All of you. That is only simple theory. That is not the conceptual issue. That is the simple clerical issue. Okay, fine. Next, coming to third entry. Now you can make final settlement to the liquidator of Z Limited. That is liquidator of Z Limited account debtor. liquidator of Z Limited account debtor. How much liquidator of Z Limited we need to pay? 17,20,000. 2 in the form of cash, 2 lakhs, I think so. Please all of you check here where it is available. Here we already decided in the form of cash, which is 2 lakhs. In the form of equity shares, 11,20,000. But please all of you remember here, out of this, we are issuing only 8,000 equity shares. Out of this 140 component, 100 is face value, 40 rupees is security premium. That's why 8,000 into 100, 8 lakhs only you should represent in the form of equity share capital. 2 equity share capital, 8,000 equity shares only into 100, 8 lakhs. Sir, what about the other components, sir? You can represent it under security premium. To securities premium account, which is 8,000 shares into 40 rupees excess, which is 3,20,000. Next, one more component is there, which is preference shares. In the form of preference shares, if you check, 4,000 into 100 at face value only you are issuing, that is 4 lakhs. But how much percentage of preference shares you are issuing? That was clearly given in point number B. 9% preference shares you are issuing. That's why you can write to 9% preference share capital. To 9% preference share capital, 4 lakhs. Can you please make total here? 2 plus 8, 10. 10 plus 3, 20. 13, 20 plus 4, 17,20,000. Like this, you need to make the final settlement to the liquidator. Next, coming to entry number 4. Now, all of you, the debentures of the selling company, you are settling. For the debentures of the selling company, you are settling your own company debentures. Your own company debentures are 7% debentures. Face value is 2 lakhs. Now, you need to write off the 6% debentures. You need to issue your own company 7% debentures. That point also I told you at the time of explaining the theory. So entry 6% debentures of Z Limited account debtor, which is how much, guys? 6% debentures of Z Limited, 2,10,000. 2, we are issuing our own company 7% debentures. Face value is how much? 2 lakhs. The excess of 10,000 is securities premium. The excess of 10,000 is securities premium. That is to securities premium account. Is it okay, guys? All of you. Next, one more thing, guys. Please don't ignore this. Liquidation expenses 10,000 are reimbursed by us. Purchasing company reimbursed to the selling company to the extent of 10,000 means we are in the books of purchasing company. What is the accounting treatment in the books of purchasing company? I'll open this diagram for your better understanding. Whenever the purchasing company reimbursed the liquidation expenses to the selling company, entry is goodwill account debtor to cash account. The same entry we need to pass here, which is goodwill account debtor to cash account, 10,000, which is for the purpose of reimbursement of liquidation expenses. Okay, don't worry, sir. Can I cancel goodwill with capital reserve? In the second entry, we got the goodwill. We are not getting any capital reserve. That's why no need to cancel. You can put like that. Goodwill account debtor to cash account for the purpose of reimbursement of liquidation expenses. So with this, accounting treatment in the books of purchasing company also over. Sir, students who understand problem number 1, they can easily think about any new problem as well. Here, understanding ability is much more important rather than concentrating on the issues, that is clerical issues and calculations and all such other stuff. If you are having a good thinking ability mode towards the accounting treatment in the books of selling company and the purchasing company, you can able to provide answers for any new questions. Maybe certain other adjustment might be different. Even though if you are able to explain 100 problems in the examination, they may ask 1 or 1 problem. always there is a scope, because these are not the ordinary BCom examination, these are the professional examination, which is far supreme while compared with all other professional exams in the commerce course. Am I right, guys? Are you with me, all of you? Do you have any doubt in this problem, or do you have any doubts in the entire concept till now what I have discussed? Please let me know. I'll quickly allocate 5 minutes time for you for your doubts clarification. Sir, please tell why you made 2 accounts of equity and preference. Aditi Tiwari, you are asking about purchasing company or selling company, Amma? Accounting treatment in the books of purchasing company or selling company? I think so. You are asking accounting treatment in the books of selling company. Why you made 2 accounts of equity and preference share? My dear, equity shares are different, preference shares are different, na? How we can club? That's why definitely we need to open 2 accounts only. What is the weightage of this question in the exam, sir? No doubt about it, ma. It will be 15 marks. No doubt about it. 15 marks. Okay. Sir, journal entries in selling company is still pending. Hiral, that is your headache. You need to provide. In the requirement, it is there. Just directly we provided the ledgers. You can provide it from your own side, ma. Next. Sir, what is the treatment of goodwill of difference? I can't understand your doubt. What is the treatment of goodwill difference, ma? Sorry, can you please come again? I can't understand that. I think so, apart from that, nothing is there. Nothing. Someone is asking that, sir, in the balance sheet, can we forward the workman compensation reserve? Here, in this question, purchasing company is taken over workman compensation liability as a liability for 5,000. For the remaining 3,000, workman compensation reserve is there, na? We should need to check whether it is statutory reserve or not. If it is statutory reserve, but there is no information given in the problem, that is other side. If such workman compensation reserve is a statutory reserve, then we should need to incorporate through amalgamation adjustment entry by passing amalgamation adjustment account at R2 workman compensation reserve account. That's good point actually, Amma. But in this problem, they were not mentioned clearly. That's why I ignored. But if something it should need to be maintained for some more years like that in the problem, then definitely I would be recorded it as amalgamation adjustment account at R2 workman compensation reserve for such 3,000. Okay. Fine, guys. Almost you are with me. Kirill asked why we write cash in Y Limited account instead of writing only cash. Y Limited means in the books of selling company. That is entry posting, na? At the time of receipt of PC, one of the component is cash. So that's why in Y Limited by cash we write. In the simultaneous posting in cash also we should need to write the to Y Limited, na? Hiral, what's your doubt is exactly? I really can't appreciate your point of view. Sir, you are teaching very nicely with 100% concept clarity. Thanks, ma. Thanks a lot. Fine. Sir, when will be amalgamation adjustment account come into the books? Sir, when amalgamation adjustment account coming into the picture, the first of all, the amalgamation should be amalgamation in the nature of purchase. Please, all of you remember this point. Don't be confused. The amalgamation must and should be amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, amalgamation adjustment account doesn't come into the picture. Why? If it is in the nature of purchase, reserves and surplus of the selling company is not taken over by the purchasing company. That's why we need to incorporate the statutory reserves with the amalgamation adjustment account. But if it is in the nature of merger, all the reserves and surplus of the selling company automatically would be taken into consideration in the books of purchasing company. That's why no need to make adjustment with amalgamation adjustment account. Okay. And one more thing. If at all statutory reserves exist and there is a clear-cut information given in the problem that purchasing company should need to maintain such statutory reserves, then only you should need to write the amalgamation adjustment account. Otherwise, you can ignore. Like in the problem, just what we done in the problem, there is no information with respect to maintenance of the statutory reserve for further more years in the books of purchasing company. That's why I didn't pass any entry for amalgamation adjustment account. Okay. So how to remember many points like workman compensation reserve, securities premium while solving? That's a good question actually. How it will comes, So sometimes the securities premium we may missed out. We may directly write like that. And at the time of presentation of the balance sheet also, we may ignore to write the securities premium. We may ignore to consider under the reserves and surplus. How that will come, na? Through practice. Through practice. Sir, if I am also resolving the first time this problem or this concept, my speed or my conceptual clarity will not be there that much. How it will come? Only due to practice. Once after listening the class or after completion of the session, if you can practice 1 or twice, okay, then the concept will be restored in your mind. After certain period or point of time, you need to resolve the problems on your own. Then you can find your own mistakes. Whenever you are committed your mistakes before the examination, you will be never committed any mistakes in the examination. That is the secret of success actually. So that's why make practice always. Don't see the concept, okay, that's okay, theory, I understand. That conceptual clarity is there. That's okay. That is not enough to crack the examination. Not only the conceptual clarity, the level of practice you should be required to give the accurate and the correct answers in the better manner in the examination. Do you understand the difference between the conceptual clarity and the concept which you have in your mind? You should need to dump on the paper. Hope you understand the difference. Okay. Fine. Okay, guys. Without wasting much time, let me entering into the another problem. This time, I will consider a small problem which is related to a calculation of purchase consideration. Please, all of you come to problem number 4. Because till now we explained the concept of intrinsic value method, but we not yet resolved any single problem on the intrinsic value method. That too, problem number 4 is important problem. I'm not telling which is tricky, but which is altogether a different problem related to the PC. There may be a chance of asking question for 5 marks. Let us consider the balance sheet of X Limited as at 31st March 2011. Share capital under note number 1, 7,50,000 equity shares of rupees 10 each given, 25,000 14% preference shares of 100 each given. Sir, before reading all such stuff, first let me check the requirement. What they required? Calculate the PC. They require the PC. That is the only requirement. Okay, fine. Let me check the other components of balance sheet. Under reserves and surplus, general reserve is given. And related to the other liabilities, long-term borrowings, maybe debentures are there. Trade payables are given. Yes, 14% debentures are there under long-term borrowings. Next, coming to assets, PPE is given and non-current investments are there. Under current assets, information is given. If you open note number 4 under PPE, total land and buildings, plant and machinery, furniture is there. Non-current investments at cost is given. Okay. If you check, all the figures are in thousands, I think so. Not mentioned. All the figures are in thousands. Yeah, fine. Come down. Y Limited takes over X Limited on 10th April 2011. Y Limited is a purchasing company. X Limited is a selling company. Always you can remember in this way, the company for which they are providing the balance sheet is a selling company. Because without providing the selling company balance sheet, even we cannot move on one foot. Okay. That's why if you observe here, they provided the balance sheet of Y Limited here. They provided, sorry, one second. They provided the balance sheet of X Limited, which is a selling company, right? So if you observe, they are given the balance sheet of selling company, X Limited. Fine. That's why X Limited is a selling company, Y Limited is a purchasing company. So next, debenture holders of X Limited are discharged by Y Limited at a 10% premium by issuing 15% own debentures of Y Limited. No need to hesitate to read such sentence as well, guys. Sir, which is not form part of PC. As per accounting standard 14, amount payable by purchasing company to the shareholders of the selling company alone treated as PC. You know, right? So that's why debenture holders of X Limited are discharged by what are the amount payable to debenture holders of the selling company? Is it not form part of PC? Not at all to read. Just ignore simply. Next, coming to point number C and point number D. 14% preference shareholders of X Limited, preference shareholders of the selling company, are discharged at a premium of 20%. Or discharged at a premium of 20% means, if you check here, the selling company preference share capital, which is 25 lakhs. For such 25 lakhs, we are discharging at a premium of 20% means, for this 25 lakhs, we are paying at 120%. 25 multiplied with 120% means 30 lakhs worth of preference shares we are going to issue. By issuing necessary number of 15% preference shares of Y Limited, face value is 100. Necessary number of preference shares means face value is 100 means 30 lakhs divided by 100 means total we are going to issue. How many number of preference shares, guys? 30,000 preference shares, right? 30,000 multiplied with 100, how much? 30 lakhs only. That's correct. So the total number of preference shares issued by purchasing company to the preference shareholders of selling company are 30,000. In the form of amount, it is 30 lakhs. Next. Intrinsic value per share of X Limited. Whenever they are telling about the intrinsic value, always the intrinsic value per equity share. Always it is per equity share. Intrinsic value per equity share of X Limited is 20 rupees. In selling company, each and every equity share intrinsic value is 20 rupees. And that of Y Limited is 30 rupees. Y Limited is a purchasing company. Y Limited will issue equity shares to satisfy the equity shareholders of X Limited on the basis of intrinsic value. On the basis of intrinsic value. Now, can you please tell me, all of you, on the basis of intrinsic value means how much amount we need to pay to equity shareholders of the selling company? First, how many number of equity shares are there in selling company? 7,50,000 equity shares are there. 7,50,000 equity shares into, for each and every equity share intrinsic value, how much? 20 rupees. That's why total intrinsic value of the selling company is nothing but 7,50,000 multiplied with 20, which is nothing but 150 lakhs, I think so. We need to pay worth of 150 lakhs of equity shares to the equity shareholders of the selling company. Am I right? Are you with me, all of you? Next. And that of Y Limited, 30 rupees. Sir, each and every equity share in Y Limited is 30 rupees. How many number of equity shares issued as PC? Let us assume, for example, I asked a question that how many number of equity shares I can issue as PC? 150 lakhs divided by 30 rupees. Because the intrinsic value per share in Y Limited is 30 rupees means how many number of shares issued as PC means 150 lakhs divided by 30 rupees. How many number of equity shares, guys? Can you please tell me, all of you? That is 5 lakhs number of equity shares I need to issue. However, the entry should be made at par value only. Oh my God. This is the first time they are asking that. They are record the entry at par value. Whenever they decided to record the PC at par value, the formula is number of shares issued as PC into face value at the par value. Can you please check me, guys? All of you. In my OneNote, I clearly explained such fact. Whenever they are going to record the PC, just a second, please. I'll open that. Where it is there. PC, yeah. Whenever they are going to record the PC at par value or face value, then the PC is nothing but number of shares issued as PC multiplied with par value. Just now we confirmed that number of shares issued as PC were 5 lakhs multiplied with the face value. Face value is 10 rupees. That's why the PC or amount payable to equity shareholders, we are going to record it at 50 lakhs. That is the reason why I considered this problem for discussion. Don't worry. Again, one more time, explain through my OneNote. Please, all of you come to my OneNote. What is the total amount of PC then? 30 lakhs plus 50 lakhs is 80 lakhs is the total amount of PC. because amount payable to preference shareholders is 30 lakhs. Amount payable to equity shareholders while recording PC at par value is 50 lakhs. 30 plus 50 is 80 lakhs. Therefore, purchase consideration is 80 lakhs. So before proceeding the problem with one note, I will ask one question here. Please, all of you, let me know. The question is, please consider, guys. What is the question is all about? The question is, can you please tell me method of PC? Method of PC, may I know? Please, all of you put your answers. Please, all of you sending your arrows to query box. Quickly, guys. Method of PC. After reading the information given in the problem, may I know the method of PC? Nobody is telling your answers here. So many members telling that PC is 80 lakhs. That's okay. But what is the method of PC? Somebody is telling NAV. Somebody is telling intrinsic value. Oh my God. Now concentrate. The method of PC is net payments method. That is the beauty of the problem. Without knowing the method of PC also, you provided the correct answer. How you know? What is the meaning of net payments method? While reading the information given in the problem, if you are able to know how much amount payable to preference shareholders, how much amount payable to equity shareholders, then automatically the method of PC is net payments method. How much amount payable to preference shareholders, I know to point number C. That is, just now I decided, which is 30 lakhs. How much amount payable to equity shareholders, I know by applying intrinsic value method. Maybe they are not directly providing, but I know how much amount payable to equity shareholders by applying intrinsic value method. That I got intrinsic value method PC is 50 lakhs. Now I added 30 plus 50 lakhs, then I got 80 lakhs, which is known as combination of one method, combination of more than one method. That means the overall PC method is net payments method, out of which amount payable to equity shareholders, again you need to another method, which is intrinsic value method. But the overall method is net payments method, out of which amount payable to preference shareholders directly given information. But amount payable to equity shareholders, you should need to apply the another method, which is intrinsic value method. That means more than one method combination is also possible to evaluate the PC amount. That is the point I try to establish here. Do you understand, all of you? That's why don't be confused. Whenever there is more than one method is applicable, you should need to apply such more than one method to know the amount payable to equity or the preference shareholders. But as per the information given in the problem, if you can able to calculate amount payable to preference shares or the equity shares, but the method of PC is always net payments method. Do you agree, guys? Hiral, even though intrinsic value is given, that is only for the purpose of knowing amount payable to equity shareholders. But the overall method is net payments method. That is the point I'm telling. Intrinsic value method is only some part to calculate the amount payable to equity shareholders method. That's why we can't tell the method of PC is intrinsic value method. The method of PC is net payments method. Is it fine, guys? All of you. Next, one more thing. One more important point here I will tell you. Amount payable to equity shareholders, we are recording PC at par value, right? Now, whenever the PC is recorded at par value, the formula is number of shares issued as PC into face value. First, we need to calculate number of shares issued as PC. Number of shares issued as PC in case of intrinsic value method, how to calculate? Number of equity shares in selling company into intrinsic value per share in the selling company divided by intrinsic value per share in purchasing company. Then what you will get? Number of shares issued as PC. Number of equity shares in selling company. How many number of equity shares? 7,50,000. Into intrinsic value per share in the selling company, how much? 20 rupees. Divided by intrinsic value per share in purchasing company, how much? 30 rupees. Then you know how many number of shares issued as PC, which are 5 lakhs. Now you can multiply such 5 lakhs with face value, which is 10 rupees. then you are getting 50 lakhs. That point also important. That's it, guys. With this, problem number 4 is over. Do you have any doubts? Oh, my dear, Miss Aditi Tiwari is asking, sir, what about remaining 100 lakhs, sir? That point, you should need to think in this way. You can take in this way. How many number of equity shares we are issuing as PC? 5 lakhs. What is the real worth? What is the real worth for each and every equity share we are issuing? 30 rupees. 5 lakh equity shares we are issuing to the selling company means in the outside market, the worth is 30 rupees. The total worth is 150 lakhs only. But such 150 lakhs, we are recording at 50 lakhs. That's it. What about the remaining 100 lakhs means nothing is happened. That point, actually, this is very good time. Actually, you asked. I told you that whether you are recording PC at par value or whether you are recording PC at issue price, both are same. I told that fact, right? Please, all of you concentrate. Please allow some time to explain that. What is the concept? Now he asked that, sir, what about that 100 lakhs difference, sir? PC is recorded at issue price or PC is recorded at par value. Both are correct. I'm telling that both are correct. How it is possible? Please let me explain. I'll explain through that my notes. 1 second. Yeah, please all of you concentrate, guys, here. Come to my notes. Aditi, if you understand this concept, then you can appreciate what happened to that difference. What happened to that 100 lakhs difference. Okay, concentrate. Sir, this is somewhat advanced concept, but the concept is pretty much easy. Please try to understand. The first issue is if PC is recorded at issue price, what will be the accounting treatment? Let us assume altogether I'm taking the different case for understanding. PC, let us take 5,000 shares we are issuing as a PC and the issue price is 20 rupees. And the issue price is 20 rupees. But the face value is 10 rupees only. Then how much will be the PC, guys? 5,000 multiplied with the 20, which is 1 lakh. If PC is recorded at issue price, then the PC will be 1 lakh. NAV was fixed. NAV was 1,20,000. How you get NAV, sir? That is different story, guys. Just for this case, directly I took 1,20,000 simply. Now, while comparing PC with NAV, whether you are getting goodwill or capital reserve, PC is 1 lakh, NAV is 1,20,000. That's why you are getting capital reserve as 20,000 in entry number 2 in the books of purchasing company. Entry number 1 is common. That is business purchase account at R2 liquidator of selling company at the rate of PC, which is 1 lakh. Don't worry. Now in entry number 3, while making settlement with the liquidator, the entry is liquidator of selling company account at R 1 lakh. Now number of equity shares issuing 5,000, face value 5,000 into 10, 50,000 in the form of securities premium, another 50,000. Now can you please tell me, all of you here, how much amount of capital type of profits are there? Due to this entire concept, how much amount of capital type of profits are there? In the form of capital reserve, I have 20,000. In the form of securities premium, I have 50,000. That is total 50 plus 20, 70,000 capital profits are there. Why you are telling that point, sir? Just wait, please be hold. Now the same case, I'm going to record at par value. Now the PC I'm going to record at par value. PC 5,000 shares. If you are going to record at par value means you are not going to record at 20, you are going to record at 10 rupees. 5,000 into 10, which is 50,000. Earlier PC was 1 lakh. Now PC was 50,000. What happens to that 50,000 difference, sir? What happens to that 50,000 difference, sir? As you asked earlier, Aditi, you asked this, what happens to this difference of 100 lakhs, sir, right? You asked that, where it is, here. What happens to the difference of 100 lakhs, sir? You are recorded at 50 lakhs, na? Now I'm telling what happens to the difference of 50,000 to 1 lakh to that 50,000. Please concentrate. Now PC is 50,000 and NAV is 1,20,000. When PC is recorded par value. Now the case is PC is less than NAV. Now the case is PC is less than NAV. Now again PC is less than NAV means capital reserve is 70,000. Now, at the time of recording the entry number 3, third entry is liquidator of selling company account debtor. How many number of shares I'm going to issue? 5,000, 5,000 into 10, 50,000. To equity share capital, I'm going to issue 50,000 only. There is no need to recording of the securities premium because I'm going to issue 5,000 shares. I'm also recording the PC at face value only. That's why there is no securities premium. Now, can you please check here what are the total capital profits? 70 plus 50. 70 plus nil. There is no securities premium. That's why capital profits are again only 70,000. Sir, that means whether PC is recorded at issue price or whether PC is recorded at par value, there is no difference in capital profits. Capital profits in both the cases same. That's why I'm telling that whether we recorded PC at issue price or PC at par value, there is no difference. There is no impact. Do you understand? So that means what really happening, if you are going to record PC at issue price, then the capital profits are split into capital reserve as well as securities premium. But if you are going to record the PC at par value, there is no chance of occurring the securities premium. Entire capital profits are occurring in the form of capital reserve. That is the only difference, except that in both the cases, the total capital profits doesn't different. Do you understand, guys? Guys, if you really understand, just follow. Otherwise, ignore. Because this is the advanced issue. Why I'm telling, sorry, even though if you are recording PC at par value, you are telling that it is as same as PC is recorded issue price. How it will be possible, sir? For that, I am telling this as a proven case. Believe me, guys, in nowhere, no author books, this concept was dealt. This was also learned by me out of my experience. Really, what is happening? Why they are going to record PC at par value? How it is different from PC is recorded at issue price? Why there is no impact? Then I researched, then I got all such information. Okay. Fine. Okay, guys. Let me take one more problem. Guys. Just a second. Yeah, which is the last problem for the current lecture. Please allow me concentrate. Just a second, please. Guys, hope you all are following with me, right? If you understand the concept in crystal clear mode, please put your thumbnails, all of you. Please put your thumbs up, all of you. Right? Can I proceed further? Super nice. Clear, sir. Crystal clear, sir. Understood, sir. With great clarity. Excellent concept explanation. Thank you, sir. Thank you, guys. Let me proceed further. Please allow me concentrate with problem number 5. The following draft balance sheets are given as on 31st March 2014. So 2 companies information is given. One is Best Limited, another one is Better Limited. Fixed assets, investments, current assets. Under liability side, shares are fully paid up. You can assume as equity shares, reserves and surplus, other liabilities. Further information, Better Limited issued bonus shares on 1st April 2014 in the ratio of 1 share for every 2 held out of reserves and surplus. You might already learn the concept of bonus shares as well as right shares in your group 1 syllabus. But even though if you are not having any conceptual background, no need to hurry. It's very simple. At the time of issue of bonus shares, what is the journal entry? Reserves and surplus account that are to share capital or equity share capital. That is the entry you need to pass. This is not at all related to amalgamation. This is the as usual adjustment at the time of issue of bonus shares. Which company issued the bonus shares? Better Limited issued the bonus shares. If Better Limited issued the bonus shares, how many number of bonus shares they issued? 1 share for every 2 held. 1 share for every 2 held means in Better Limited total 10 lakhs divided by 100 means, I think so 10,000 equity shares are there. Am I right? 10,000 into 100, which is equal to 10 lakhs. Yes. 10,000 equity shares are there. For every 2 share, 1 bonus share means for 10,000 shares, how many number of bonus shares, guys? 5,000 bonus shares are there. At the time of issue of bonus shares, I already told the entry reserves and surplus to equity share capital. 5,000 into 100, which is 5 lakhs. You need to reduce the reserves and surplus 5 lakh. You need to increase the equity share capital 5 lakhs. That means after issue of bonus shares, how the Better Limited balance sheet will become, you know? Here you need to add plus 5 lakhs. Here you need to reduce minus 5 lakhs. That means equity share capital will become 15 lakhs. Reserves and surplus will become 3 lakhs. That is the impact. Come down. First of all, what he required before reading all the information, first let me check what the requirement is all about. Make the closing ledger in the books of Better Limited. Closing ledger in the books of Better Limited. If he is talking, Better Limited is a selling company. Automatically Best Limited will be a purchasing company. By seeing such information, you can easily appreciate that Best Limited is ready to take over Better Limited. And the opening journal entries in the books of Best Limited. He is asking that closing ledgers in the books of selling company and the journal entries in the books of purchasing company. And also prepare the balance sheet as at 1st April 2014 after the takeover. First time we are seeing that need to prepare the balance sheet after completion of merger or after completion of amalgamation in the books of purchasing company. Fine. Now let me check the further information given in the problem. It was agreed that Best Limited will take over the business of Better Limited on the basis of the latest balance sheet. What is the meaning of latest balance sheet? Latest balance sheet means after issue of bonus shares by the selling company to their equity shareholders. So we already prepared the latest balance sheet. The latest balance sheet is equity share capital 15 lakhs, reserves and surplus is 3 lakhs, other liability there is no change. For the assets also there is no change. That is the later balance sheet. On the basis of such later balance sheet, purchasing company is ready to take over selling company. And the consideration taking in the form of allotment of shares in Best Limited. PC is in the form of fully paid up equity shares only. They are telling the value of shares in Best Limited was considered to be 150 and the shares in Better Limited were valued at 100 rupees after the issue of bonus shares. The allotment of shares is to be made on the basis of these values. Even though they are not mentioned specifically, these values are intrinsic values. The method of PC is intrinsic value method only. Because they are clearly intimating you that in the books of purchasing company, each and every equity share value is 150. In the books of selling company, each and every equity share value is 100. And they also mentioned that the allotment of shares, that is PC, is to be made on the basis of these values only. The PC is going to be distributed on the basis of intrinsic value method only. Now, can you please tell me PC under intrinsic value method how much? Number of equity shares. Number of equity shares in Better Limited. How much? After issue of bonus shares. That is 15 lakhs divided by 100 means 15,000. 15,000 shares we are issuing as PC. And each and every share we are issuing how much? 150. Tell me guys, 15,000 into intrinsic value per share is 100. That is 15 lakhs. That is 15 lakhs. The amount of PC is 15 lakhs. How many number of shares you are issuing as PC divided by 150? That is how many number of shares, guys? 10,000 shares we are issuing. Yes. Number of shares issued as PC were 10,000. Amount of PC issued as 15 lakhs. If the same point they are mentioned that PC is recorded at par value, then PC will be 10,000 into 100. It will become 10 lakhs. Are you with me, all of you? In the old problem, the same thing was given, except that PC is recorded par value. But here that point was missed out. That's why you can record PC at issue price only. That is 10,000 into 150, which is 15 lakhs only. Do you follow, all of you? Fine. Come down. One more time I will explain, no worries. At the time of recording the answer in my OneNote. Liabilities of Better Limited include 1 lakh due to the Best Limited. Intercompany owings. Under special adjustment we learned, in case of intercompany owings, the entry is liability to asset, trade payable to trade receivable. bills payable to bills receivable, loan payable to loan receivable. Liabilities of Better Limited include 1 lakh due to Best Limited for purchases from it, on which Best Limited made profit of 25% of the cost. The goods of rupees 50,000 out of the said purchases remained in the stock on the date of the above balance sheet. For which purpose this is given, sir? Stock reserve concept. What happened in between Best Limited and Better Limited? This is about Better. This is about Best Limited. He is telling that liabilities of Better Limited include 1 lakh due to Best Limited. Okay, that means in Better Limited liabilities, 1 lakh is there for Best. 1 lakh is a creditor of Best. Now in Best Limited assets, under debtors, Better Limited will be there for 1 lakh. Straight away, these are crossing with each other by passing the entry, the trade payable account debtor to trade receivable. That's okay, fine. Sir, why the creditor and debtor was actually established before occurring of process of amalgamation? Maybe Best Limited sold certain goods to the Better Limited, due to which Better Limited should need to pay that 1 lakh to the Best Limited. To continue with the transaction, they also provide the additional information that the goods of 50,000 out of the said purchases, Better Limited purchased 1 lakh worth of goods, out of such goods, 50,000 remained in the stock. Now, during the process of amalgamation, Best Limited also taken over this stock, 50,000. Now, Best Limited sold goods to the Better Limited by adding 25% profit on the cost. If cost is 100, profit is 25, selling price is 125. Now this 50,000 is showing at 125, out of which unrealized profit lying in the closing stock in the form of stock reserve we need to eliminate. For 125 it is 50,000. Then for 25 how much? 25 multiplied with 50,000 divided by 125, which is 10,000. What is the journal entry for stock reserve? Can you please tell me, all of you? Goodwill account debtor to stock reserve account, 10,000. That is the adjustment entry you need to pass for this stock reserve. That's it, guys. Make the closing ledgers in the books of Better Limited and also the opening journal entries in the books of the Best Limited, and prepare the balance sheet as at 1st April 2014 after the takeover. I'll do one thing. Please, all of you try this problem, guys. We are not having enough time to resolve the problem, but hope I told the each and every adjustment. What you will do, PC was directly given, which was 15 lakhs, which is under intrinsic value method. Provide the closing ledgers in the books of the selling company. I will tell you the journal entries in the books of purchasing company as well as balance sheet in tomorrow's session. Please, all of you complete the closing ledgers in the books of Better Limited. Okay. What you should need to do, you should need to open the realization account. Here, all the assets, all the liabilities are taken over by the purchasing company. You can also open the equity share capital account. You can also open the Best Limited account in the books of Better Limited. Then dismantling of balance sheet, PC due, PC receipt, then payment to different parties. That is, payment to different parties means there is no party exist here. Only the party is equity shareholders. Then close the realization account, find the realization profit or loss, then transfer to equity shareholders account. Then make it final settlement to the equity shareholders. Please complete all of you that part in your books, but please don't ignore that bonus shares are issued before occurring all such amalgamation entries. First, you should need to issue the bonus shares, that is, reduce the reserves and surplus and increase the equity share capital by passing the entry reserves and surplus to the equity share capital account. After that, only the reserves and surplus and equity share capital you can transfer to the equity shareholders account. Is it okay, guys? All of you. So just please try. All of you, please try that thing. If you're unable to resolve, I will tell you in the next session. Okay. Hope you are enjoying my session, and please complete the problem part as well. Then we will meet in the next session. Until bye. Have a nice day, guys.